Picture this. World leaders walk off a stage shaking hands and markets cheer. Then within hours, Bitcoin crashes, stocks slide, and $1 billion fast casual chain, Chipotle, warns customers are tightening their belts. What just happened? Is this the calm before another storm? Or the reset the market has been pricing in for months? Stay with me today because everything is connected. Trade, tech, retail, and Bitcoin are colliding in real time. And I am going to break it down for you right now on the Daily Hodl. So what's up, family? It's Coach Masi, and you better be locked in to the Daily Hodl every day. Quick favor before we dive in. If you want clear Bitcoin news and market plays explained without the noise, smash that like button, subscribe, and hit the bell. Share this with someone who loves Bitcoin and wants the big picture. This episode is for educational purposes only and not financial advice. You should already know that if you've been on my channel. So, we have three headliners today that tie together. A one-year trade truce between the U.S. and China announced after Trump and Xi met. Bitcoin dropped back toward 106,000 as the crypto complex sold off. And Chipotle reported earnings that spooked investors because customers in general are freezing and feeling the squeeze. The Trump-Xi truce, though, is real and is being reported as one-year pause in trade escalation. On the surface, this should be a tailwind for risk assets. But markets hate uncertainty about details. In other words, headlines can cheer the crowd while traders still worry about how deep the deal goes and what gets left out. Today, we saw that exact behavior in real time. People are wondering what's going on, but that's what's going on. You see, Bitcoin moved quickly on the chop. At several points during the recent spell, Bitcoin retraced to 106,000 a day. And liquidity events and macro caution are all colliding, and that's why. You see, retail, we also had Chipotle stunned investors with the result that basically affordability is not here and that it's starting to bite into customer frequency. And the stock took a hit as a result. The corporate weakness, well, tells a story about the consumer that you just can't ignore. Sentiment is important in markets. Well, those are the headlines. Now let's unpack the why and the what next. Okay. A one-year trade truce means something specific. It buys time. It pauses escalation on tariffs and export controls and opens a window for talks. That window can bring clarity, which markets usually like. But this is a truce, not a final settlement. And we know the devil is always in the details for both countries. So why does this matter for Bitcoin? Because macro clarity shifts liquidity. If the truce leads investors to believe global growth will stabilize and supply chains will loosen, money will rotate back into risk assets. That rotation can be supportive for Bitcoin if liquidity expands. But if the truce is thin, enforcement and the market smells that out is basically ambiguous, traders will hedge and we get volatility. Today, the market shows caution first, and that pressure rippled into Bitcoin and all crypto. Politically, this is huge too. A visible handshake between two superpowers reduces one global tail risk. The market will price the reduction of that tail risk slowly and skeptically. Your job as a viewer and investor is to watch whether policy details follow and whether corporate guidance changes in the weeks ahead. So let's zoom into Bitcoin. When Bitcoin moves from 116,000 to 106,000 or below, there are a few mechanics at play. First, liquidity clusters at around numbers. 106K has been known as a pivot area. Second, macro flows matter. When risk assets wobble, leverage positions get liquidated, and that amplifies moves. Third, narrative, right? The trade truce is not finalized. Nobody really knows. And then you're getting offbeat commentary from central banks, and you're going to see a sharp pullback in the crypto liquidity, especially in Bitcoin. Because Bitcoin goes down, it really sucks the life out of all the other alts. Remember this, corrections are painful, but they're normal. Healthy bull markets have corrections. What you want is for accumulation versus distribution. Are long-term hodlers basically, are they holding or is there more outflows than inflows? You got to check the data points or see if it's just a shallow correction and nothing deeper. If you're a Bitcoin investor, stay disciplined. Dollar cost average, use major support areas as reference points, but never forget to plan for both scenarios, a sustained recovery and an extended consolidation. You see, markets are complex. Today, the S&P and the NASDAQ felt the pressure as mega caps and tech names softened, while the Dow showed some resilience from legacy cyclical plays. That mixed breath is important because it signals whether the move is concentrated or broad-based. Today's drop felt broad enough to rattle confidence in everything, but not so broad that it just triggered a full panic and capitulation. So what does that mean for you? Well, as the breadth deteriorates and selling widens to small caps and international markets, the risk of deeper corrections rise. Stay data driven, watch credit spreads, and watch treasury yields. Those are the real clues about whether the sell-off is structural or tactical. Or watch me and I'll tell you. You see, we also have Chipotle. Obviously, they showed that same-store sales and traffic metrics showed weakness, and management pointed to affordability pressures as a driver for lower frequency among customers. That is the canary in the coal mine. When restaurants with pricing powers start to lose foot traffic, it signals consumer fatigue. This matters for markets because customers and consumers altogether are spending drives roughly 70% of the US GDP. So if affordability causes pullbacks in dining out and discretionary spending, well, corporate earnings will be under pressure. And that will feed into stock prices and investor sentiment. Keep an eye on consumer discretion. Names and retail foot traffic metrics are coming in the next few weeks. The big lesson here is simple. Equity markets can rise even when the real economy weakens, but at some point, the real economy pulls the market back into reality. Now, take the three threads together. A 1-year trade truce lowers a geopolitical tail risk if it holds, but it also creates a story about policy uncertainty until details arrive. Bitcoin fell because traders rotated and liquidity evaporated, and Chipotle fell because real people are making different decisions at the checkout line. And the market sold off because, well, the narrative changed. Fear ticked up, and algorithmic flows amplified the move. You can even see it on X. You see, that means your playbook should be flexible. On days like this, you do not want to be rigid. Reassess your risk, check your liquidity, your cushions. And if you are a long-term believer in sound money and Bitcoin, use volatility to add in measured increments only. Don't invest nothing you could afford to lose. Here are the three things I want you to remember from today. 1. Headlines do not equal policy. A handshake between leaders starts a process. It does not finish it. 2. Bitcoin's pullback to the low 106 area is painful, but corrections create opportunity for disciplined buyers. And 3. Chipotle's miss is not an isolated retail problem. It is an affordability signal that you need to watch across consumers facing companies. So now, I want to hear from you. Which story worries you more right now? The geopolitical trade truce or the consumer squeeze at home? Drop your take in the comments and let's debate it. If you found value in today's breakdown, hit the like button, subscribe, and tell me if there's any other topics you want me to discuss on the financial news. Remember this again, not financial advice. You're investing your own money. And last but not least, that's your Daily Hodl. Stay sharp, stay disciplined, and as always, Lead.Pray.Hodl. I'll see you on the next one.